Coming up in today's show, the US economy adds 336,000 new jobs in September, almost double from what was expected. Long-dated bond yields still rising, the market pricing in a possibility of another Fed hike, stocks surprisingly rally, and are the new weight loss drugs really threatening to food stocks? Welcome back to the Click Capital Daily Market Show, everybody. My name's Jared, and I hope you're having a great Friday, Saturday, or Sunday, wherever you are in the world. And it was a bit of an interesting day on Wall Street to finish the week out, with non-farm payrolls coming in, showing an almost 100% increase on what was expected, showing the jobs market is still tight. And just looking at a 15-minute chart, that initially caused a sharp spike in the 10-year yield, getting up to 489, and a bit of a gap down the S&P 500, coming off about 40 points in early morning. However, the stock market managed to stage a surprise rally, filled that gap, and finished near the highs for the day. So we did get a bit of an unwinding today, but to the upside, which was a bit of a surprise because lately in the market, good news has been bad and bad news has been good, because the market's really looking at and keying off rates and whether the Fed is going to hike again or they're done. However, we saw the Nasdaq lead the way higher today. As we've been noting recently, tech's been holding up the best. And so all of the Magnificent 7 had a good day, and there was a bit of bullish breadth out there across the board. Industrials traded up, so did healthcare, utilities, and it was only really consumer staples that one we saw a bit of continued weakness, with the market seeming to continue to react to the new blockbuster weight loss drugs and the real potential for Americans to consume less calories on average. So stick with me, I'll get into that one a bit later along with some other topics. However, first let's start out by looking at non-farm payrolls. So economists were expecting the US economy to have generated 170,000 new jobs in September. It came in almost double at 336,000. You can see that was a bit of a bump up, and the highest number we've got all year bar January. And most of those job increases came from three sectors: leisure and hospitality, government, and healthcare and social assistance. And because we still have core inflation more than twice the Fed's target, this latest jobs report just makes this guy here job that much harder, because it just pushes further back the date where he can officially say the Fed is on pause and they definitely don't need to hike rates anymore. And I'd say him and his mates are probably quite surprised that the most aggressive Fed rate hiking cycle in history has yet to damage the jobs market. Has been quite resilient this year and holding up pretty good. And he knows for inflation to structurally come down, you need to see the jobs market loosen up, even though it's not politically correct for him to come out and say that. And if you really want to get on top of inflation, then a good old recession is needed to do that as well. So the market's back to really not so sure what it's going to do now, with Fed Fund futures pricing in almost 40% chance the Fed will hike again in December. However, I'd say we need to see some further strength in the jobs market and inflation CPI data between now and then for those odds to really firm up, because I think the Fed would really like to be done. However, if we do see a material uptick in inflation with the jobs market remaining tight, they may have no option but to throw in one more hike and try and cool the economy again and prevent a second wave 70s style resurgence in inflation, which they really don't want to see. However, for now, there remains a lot of upside pressure on bond yields, and the 10-year around 4.8% really isn't that high when you look back over history. It averages more around the 5-6% mark, which we could still easily see over the coming months. So even though we had the short end of the curve in the 1-year and 2-year yields pulled back a little bit and consolidate here, if you look a bit further out at the 5-year and the 10-year, and the 30-year, which actually found new highs today, above 5% to 505, and we haven't seen those levels since back in 2007 before the great financial crisis. And just looking at this price action, to my eye, I don't think we're near a top yet, even though we are technically overbought here. This to me looks more of a melt-up surging pattern that could potentially go into that blow-off top. So even though we did have a good rally in the S&P 500 today and the Nasdaq up 1.68%, almost back at its 50-day VWAP, I'm not sure if I'm buying this rally as a real short-term bounce or maybe a kind of bear market style rally, kind of bull trap potentially, because we did see bond prices trade lower today with TLT finding new lows again. And if these bond yields don't cool their jets anytime soon, it's hard to see how stocks can sustain a good bounce and rally in the face of that. So even if the Fed doesn't hike rates again this year, at the very least they should hold them steady. And that higher for longer theme will continue to remain for some time yet. And we can see that higher for longer theme play out in this chart here of the target rate probability history for what the Fed funds rate will be on September next year. So you can see before the regional banking crisis hit in March this year, the market was given the greatest probability the Fed funds rate would be around 4.5%. They absolutely fell off a cliff, and pretty much the entire market thought that the Fed was definitely done. For much of that time there was less than a 1% chance that the Fed would ever hike again. And then we all thought the regional banking crisis along with high rates, inflation, would help tip the economy into a recession by now, because lending standards were tightening, a lot of regional banks were in trouble. However, the Fed swooped in quickly and saved the day, backstopped the system, opened the window to some borrowing, kept the liquidity flowing, and the regional banking sector has actually come out of it so far so good, actually holding up pretty good, along with the jobs market, and that's why we're seeing Fed fund futures continuing to price in this higher for longer, with the greatest probability of the Fed funds rate being around 4.755% by September next year, and the chance that we may actually be higher down here in the grey has actually been growing as well. So it's going to take something big and surprising for all this to get back down to flat down here, and this higher for longer theme isn't going anywhere anytime soon. So the economy is just not slowing down as we had all expected by now, and that's really not a good outcome for stocks, because the higher yields go, the more appealing bonds become, and the higher the cost of capital for businesses, making new investments needing to earn a higher rate of return to justify the investment. So it was pretty surprising to see stocks bump up today, and you may be wondering why is that? And that's a really good question. I mean, it's anybody's guess. You could say we're coming off a technically oversold level, maybe there's short covering, maybe the market's positioning itself for some upcoming bullish seasonality, maybe it's a head fake from algos, maybe the market thinks Q3, Q4 earnings is going to come in a lot better than expected. It's really anybody's guess as to why we did get that good rally after that really surprising non-farm payrolls report. We did see yields pull back come lunchtime, which no doubt helped stocks rally up. However, like I said, I think these long-dated bond yields could be going into a melt-up pattern, and that's really not good for stocks. So I wouldn't be surprised if the stock market's setting up for a bit of a rug pull next week. And like I said, I'm still not convinced by this rally is a real short-term bottom, even though my custom technical indicators, the dark pool percentage and S&P 500 oscillator, are showing a high probability that we are at a short-term bottom, and the market could indeed rally again on Monday, Tuesday into next week, and potentially even do a gap fill back up to around 4,400 and S&P 500, around its 50-day VWAP. If those yields don't let off much, then I'd expect the stock market to fall over again and continue this downtrend we've been in since late July. And some strategists out of Bank of America today share a similar sentiment, saying stocks have more room to fall as a recession and credit event lay ahead before the Fed eases policy. And it's true, looking back in history, the Fed usually cuts after something breaks and things go really bad, and they kind of scramble to try and put a floor in the economy and markets. And I'd say the Fed is going to keep their foot on the gas by at least holding rates and keeping the window open to another hike, and just hoping the jobs market and economy before they're forced to do another rate hike. And by the time that happens, stocks could have already tumbled 20% or more, just like JP Morgan's chief strategist says, who's cautioning investors against buying the Magnificent Seven. As he said, current stock valuations seem way too high given investors can earn solid risk-free returns from treasury bonds and savings accounts. And that's true, because according to my optimal stock bond allocation indicator, bonds are now the most attractive relative to stocks since going back to 2007, with my custom indicator saying an optimal allocation to bonds now is 58% versus 42% in stocks. And that's because you can just get a much higher short-term yield from bonds versus the earnings yield in stocks. Doesn't mean there aren't bargains in individual names out there in the stock market, but just talking as a whole and looking at the S&P 500 NASDAQ indices, they are quite overvalued relative to bonds. And so this is the first time my indicator has recommended a higher weighting to bonds than stocks throughout this entire bull market since 2009. And as we're seeing on the line chart here, the S&P 500 could be setting up an epic double top. With this big bull market's momentum slowing, we could be in for an extended period of weakness and sideways action. Moving on today to another theme playing out through markets is that of the new blockbuster weight loss drugs, Ozempic and others, which seem to be working really well and suppressing people's appetite. That's causing big losses in the consumer staples sector and food stocks. That's been kicked off a bit by the CEO of Walmart's US operations, saying they're seeing signs of some consumers buying less food. And I'd say the companies most exposed to this potentially new consumer trend is that of the snack companies like Mondelez, Coke, Pepsi, and others like that, who sell those cheap sugary snacks. And that's where most people add on those extra calories, is in between meals. And so the average American consumes about 3,800 calories a day, which is a lot higher than the recommended daily intake of 2,000 for women and 2,500 for men. So those weight loss drugs could have a material effect long term and help correct that overconsumption of calories. But the market does appear to be worried about it, With consumer staples, the only sector coming off today, 0.55%. And just looking at the price action in Coke and Pepsi, which managed to hold on a bit there today, and Walmart that actually came off really hard before being dip bought, and others like Mondelez and big snack maker out of Switzerland, Nestle, all been trading really weak of late. And so this could be a bit of a short-term overreaction, and be hard to imagine their profits would be seriously and materially affected right now. However, a lot of the money in the market is long-term thinking, and I'd say some big investors see this as some strong long-term headwinds when overconsumption is a real problem in our society, and a lot of these companies that sell these cheap sugary snacks contribute to that. Drugs like Ozempic could be just the start of more to come in the fight against that. Moving on to economic data we got today is the unemployment rate at 3.8%. Average hourly earnings increased 4.2% year over year. There's the big one, non-farm payrolls coming in almost double as expected, and average hourly earnings were down a little bit less than expected month over month, 0.2% increase. Looking out next week, we don't have much to start the week off. We do have a bunch of Fed speakers with some producer price indices coming in, and then the big one will be Thursday, CPI core inflation rate, with headline inflation expected to increase 3.6% year over year, core inflation to be 4.1%, and those numbers have been ticking up a little bit over the last couple of months. And again, this one's going to get yields moving if we get a surprise here. And maybe those higher oil prices over the last couple of months do give us a bit of a surprise uptick. And again, that's just going to keep yields ripping higher and should keep a strong lid on stocks. Market's still on shaky ground with the fear and greed index at 29, and still no signs of interest from corporate insiders in buying this market, with only 35 recorded purchases yesterday. Looking out across international stock indices, we've got a bit of a bump to finish the week. There's Canada's TSX, the UK FTSE, the German DAX, China 50, the Nikkei 225, and the Aussie 200 all trading up from these lows. And as you'd expect, we got a bit of a pullback in the VIX down to 17.4, but still pretty elevated compared to what we've seen over the last couple of months. And pretty busy day on the options market, coming in just under 45 million contracts traded, and 53% of them were calls. Causing that put-call ratio to dip back down to 0.83, showing there's probably a lot of retail traders buying into this bounce here and expecting more further upside next week. We did get a bit of a bounce in short-term breadth, 23% of stocks above their 20-day average, but not much of a bounce of stocks getting it back above their long-term 200-day average. And believe it or not, we've still got more stocks making lows compared to highs, 140 to 22 on the NYSE, and 139 stocks hitting new lows versus 24 on the Nasdaq. Mega cap tech continues to hold the indices up. We can see that in the growth versus defensive sector spread, and growth versus value stocks actually broke out to new year-to-date highs, and we can see that trend in Nasdaq versus Russell, with tech continuing to outperform. There's commodities pulling back versus stocks, but we've still got those yield curves steepening, along with inflation expectations still on an uptrend. International bond yields still firm, and there's high yield bonds trying to find a bottom, along with the dollar coming off a little bit. Bitcoin still holding strong, and a little bit of a bounce in commodities, with gold trying to find support here around 1840 an ounce, and same with crude too, down in the low 82s. There's natural gas moving up again, and a little bit of a bounce in copper. Looking at stock sectors, green across the board except for consumer staples. The gold mine is leading the way up over 2%, and we got a nice bounce in utility stocks. And since the utility sector is beaten down, I've been looking for some bargains in there for potentially a long-term buy. And one name that caught my eye was NextEra Energy, which according to my stock fair value indicator is undervalued by 40% now. And we look to have put in this hammer candle formation today. And basically NextEra Energy, based out of Florida, one of the largest renewable energy stocks in the world. They're involved in wind, solar, and nuclear. And just looking at a long-term monthly chart of NextEra, it's been a really good performer over the long term, as they are positioned well for the transition towards clean energy. However, with these rising yields, they haven't escaped the pain from the utility sector either. And they're a $103 billion market cap company with about the same dividend yield as the utility sector, 3.78%. What's also adding to my conviction in this name is the huge amount of buying going on in the dark pools, as you can see by my dark pool percentage indicator, showing at 80% today. And the NextEra board of directors seem keen on the stock as well. We saw that back in August, with one director purchasing $680,000 worth of stock, another one purchasing $270,000, and the CEO buying over $1 million worth of stock back in mid-June. And he paid $74 a share for that stock. And apart from one sell for $300,000, going back earlier this year, insiders were loading up as well millions of dollars worth of stock, and they were happy to pay around the mid-70s. So are currently trading at $50 a share. One could jump on board with them at a much lower price than they've been buying recently. And even though there's a lot of downside momentum, this thing could easily trade lower, down into the 40s and 30s. I've got this one on my watch list, and if that dividend yield starts approaching 5%, I will start getting interested in it myself, as a long-term value play, and if I could pick it up for around $40 a share, in my mind I think that's a good risk reward, considering they generated about $4 per share in earnings over the last year. Once the market eventually stabilizes, that should prove to be a good investment. Looking across popular stocks, we got Apple pop up today from that support zone it regained. Microsoft did a good job as well, up 2.5% reclaiming its 50-day. And Google, probably the best performing mega cap tech, coming back up to highs. Amazon's still a little soft. And NVDA now back above its 50-day, continuing this sideways trading, and Tesla still drifting sideways as well. Got a big pop-up in Meta, up 3.5%. There's that recent IPO, Instacart, finding new lows, and the chipmaker ARM managing to hold on. Looking across the meme space, we did get some big jumps across the board there. However, a lot of them are still well off their highs, like leader Carvana. And there's a look at another old economy stock I think's undervalued, General Motors, popping up a bit today. The other one we're watching, Walgreens, off 1.6%. They've got earnings coming out in 6 days. We're expecting them to earn 69 cents per share. There's 3M trying to find a bottom. The other stock I'm interested in, Sphere Entertainment, up 3.2%. And the telecoms came off a bit hard today. AT&T and Verizon down 3%. Was dip bought on this hammer formation though. And that's because the stock just went ex-dividend, paying out 66 cents a share. But it still finished the day down 97 cents lower. And those regional banks continue to hang in there, with the big banks looking to find a bottom and just popping up a little bit here. Okay, so there we have it on the S&P 500 index. Trying to hold on to that trend line here, or so it appears. Currently sitting a bit over 4,300. We could see a bit of follow through into next week, maybe come up and tag that 50-day, fill that gap around 4,400. However, unless we get a big pullback in yields, I'd expect stocks to fall over again. If not a complete rug pull from just underneath our feet, catching a lot of people by surprise, especially all those people loading into call options today. Because like I said, looking at the price action and the 10-year yield, I'm not convinced that's a top. It's kind of hard to say. We could still go into a melt-up pattern here, especially with that strong jobs report. And I guess the big one is CPI coming on Thursday, and look out if that comes in a lot hotter than expected. So as always, interesting times in the market, and we'll just keep following the price action, playing it day by day, and see what we can make of it all. That's all for this week. Thanks very much for watching my daily show. I really appreciate all your support and feedback. Hope you have a great weekend, and I'll see you on Monday afternoon. Cheers.